Hi, I'm Pattu from freefincal. Let's take a look at how active mutual fund SIPs have performed against Nifty 50 SIPs over the last 15 years. And I was surprised to find that active mutual funds as a category have struggled to beat the Nifty 50 over the last 7 years. And by active mutual funds, here I mean all large cap funds, large and mid cap funds, small cap funds, and multi cap funds. So, some basic stats here. So, if you have if you had started a SIP in the Nifty 15 years ago, your return would have been 10.14%. There are 31 funds with a better return than that, and 26 funds with a lesser return. That itself is quite significant to say that there are 26 active funds that have failed to beat the Nifty over 15 years. Some of the most prominent underperformers are HDFC Equity, HDFC Top 100, and Franklin India Blue Chip. Some of you may say, that's not a big deal, I expected that. But if you had invested in these funds 24 years ago via SIP and did it faithfully, the 24-year returns for the SIP returns for HDFC Equity is 19.2%, HDFC Top 100 is 17.2%, and Franklin Blue Chip is 17.4%. That is about 5-6% more than the Nifty 500 returns of 13.95%. I couldn't get the Nifty 50 data, but that's a significant alpha, if you call it. That's a significant extra return which has suddenly dramatically dropped, and you can see the numbers. It's kind of baffling. So what you have here is 4 columns, and the first column is the SIP tenure on the left. The next is the Nifty 50 return. We saw this in yesterday's video. And the next column, you have the number of funds which have got more return than that Nifty 50 return. And the last column is the number of funds which have got less return. So 15 years, over the last 15-year SIPs, you have 31 funds with more return, 26 funds with less return. 14 years, 37, 26. 13 years, 47, 29. 12 years, 49, 36. 11 years, 50, 39. And then you can see at 10 years, you have 51 funds with more return, 44 funds with lesser return. And at 9 years, the trend reverses. You have 47 funds with more return, but 51 funds with less return. So about 9 years, 10 years itself, choosing an active fund that has bet the Nifty, it becomes a coin toss. It has got a 50% probability. Either you get it or you don't. It's 50-50. But then 8 years, it becomes 43, 57. 7 years, dramatic drop, 29.75. 6 years, 16.92. 5 years, 15.97. 4 years, 13.99. 3 years, 24.93. 2 years, 42.82. That's a big improvement. And then the last 1 year, it's 40.96. So I think AMCs have kind of rallied a little bit, but it's still significant underperformance over last 1 year, 2 year, 3 years, even then. So that's the big problem here of choosing active funds. You just don't know what your which fund is going to beat your Nifty 50. But what do you do? What do you do with that? The problem, I've been saying this for a long time. It's not just with this result. Unfortunately, you had all sort of comments when you speak the inconvenient truth. The point is, investors should stop defining their investing success in terms of returns. They should just use it as a wonderful comment yesterday. I forget the person who said it. Just like somebody said, you should just use it for goal-based investing. When you are planning for a goal, when you are planning for retirement or a child's education, whatever, you need to have a return estimate in order to find out the amount of money you need to invest for that goal. For that estimate, you use some return estimate and keep that return estimate low. For example, you can have 10% before tax for 60% equity allocation and 7% return from fixed income before tax for about 40% equity allocation. This means that the overall portfolio return is about 8.8%. You can use this to calculate the monthly investment, but that's only the first step. Of course, naturally, this would mean that the amount you need to invest is going to be high, because most people make the mistake of using 12% returns without any asset allocation. They will put 12% in a goal planning calculator. I don't know what kind of logic is that, but that's what they do. So you at 8.8%, obviously it's going to be a little tough for you to invest as much as that amount, but at least you should try. And every year you should keep increasing that amount as much as possible. Like I said last time, you have to try and increase your income, you have to try and increase your skills, and try to improve your income and keep your expenses at bay. There's no other choice. I mean, otherwise you're going to suffer at some point. So this is the simple truth. I mean, think beyond active versus passive funds, because okay, active versus passive funds, the debate is always going to be there. Some people are going to argue one way or the other. Forget that. There's something beyond that which you have to worry about. And the reason I'm talking about low return expectations is because there's a bit of a double tragedy here. One is, not only have active funds found it difficult to beat the Nifty, but over this period, Nifty returns have fallen. If you say, okay, Nifty has concentration risk, etc., and Nifty return is very high, then you can say active funds have found it difficult to beat Nifty. But you saw yesterday that the last 10-year returns, 8-year returns, 11-year returns, they are not very high. They are only like 10%. If an active fund is not able to beat the Nifty and get you 10% plus returns, because the old returns of Nifty was like 14%, 15%. That was a tougher target to beat. The target has become lower, but even then the active funds are not able to beat. So it becomes a big problem. It's a double whammy for the Indian investor. If you ask a question, has the Indian stock market investor been rewarded for taking the extra risk? I would say very, very debatable. I'm almost inclined to say no. They have not got the reward for the risk that they have taken. This is a simple truth. Of course, that doesn't mean you should exit everything and go. That is not what I am trying to say. People call me conservative and so on. I have 60% of my money invested in equity, and I'm never worried about returns, because I have a goal-based approach, and you know what I do. So that's not the problem. So that's what I'm trying to tell you. Stop thinking in terms of returns. Go beyond active versus passive. Focus on the money you're trying to invest. You can choose whatever you want. It's ultimately your choice. You can be active or a passive investor. But whatever you do, ultimately, if you are not able to invest enough money, you are not going to get a corpus you want. This is the simple truth, because you don't have too much control on the returns. Whether it is Nifty or an actively managed fund, returns are simply going to be, it's just luck. Whatever happens is going to happen. You can say, I will tactically do this. Some people always comment like this. You need to time your market and so on. All those noises I've been hearing for years. But that's fine. I'm just inclined to just ignore them. Ultimately, the wealth you create will boil down to the amount of money you invest. So please start thinking about that. Please start thinking about increasing your skills and increasing the amount of income that you get. The only way you can increase the amount of income you are going to get is by managing your time efficiently. You have to put in the effort. You have to forego all these IPL matches. You have to struggle and work. In spite of your hectic work schedules, you have to somehow find a way in the weekends to focus on your side income, your second career, whatever you want to call it, and try to improve the amount of money you invest. So if you have any questions on this, comments, let me know. Bye bye.